Hey, what's up guys? Mike here of Money and Life TV. In this video, I'm going to be covering with you guys this new type of loan that's coming out in July of 2018. It's called, by Freddie Mac, it's the Home Possible Mortgage Loan. So we're going to be taking a look at that. But we're going to be covering three main things in this video. And I got some notes right here I want to pull up. So we're going to be looking at why I think this new type of loan, this Home Possible Mortgage Loan, is a strong signal for the decline of the U.S. real estate market. Secondly, we're going to look at should you buy a home using this new loan. And third of all, we're going to look at some realistic examples of what it might look like if we actually bought a home using the Home Possible Loan. And I got some other articles in here as well. And I have a very special treat for you guys at the end of this video, so I would recommend sticking around. I think it's fascinating. I was blown away when I saw the numbers, as we'll be looking at what the median home price for a new home is today versus like 40, 50 years ago. It is astounding the difference. Okay, so let's just go ahead and dive right into this. Now, I know this is not a typical type of video that I produce on this channel, but I feel that this is a very important topic. Knowing the health of the real estate market is very important in my opinion. And so I really wanted to talk to you guys about this and just really I've been seeing this kind of stuff and reading about it and watching and listening to about it, and just like, I got to share this with you guys because I think it's important to know what's going on out there and just to keep aware, just to be aware of what's going on around you at all times, because that will definitely can impact your financial situation, your investments, taxes, etc. So let's look at what is Freddie Mac. Who is Freddie Mac? So it says about us, it says we make, and this is all from their website, guys, we make home possible for home buyers, homeowners, and renters nationwide. And it says Freddie Mac makes home ownership and rental housing more accessible and affordable. Operating in the secondary mortgage market, we keep mortgage capital flowing by purchasing mortgage loans from lenders so they in turn can provide more loans to qualified borrowers. Our mission is to provide liquidity, stability, and affordability to the U.S. housing market in all economic conditions. Extends to all communities from coast to coast, and they truly are nationwide. And so Freddie Mac and Fannie Mae, you've probably heard of them, they are basically owned and operated by the government at the moment, or at least the majority of it is, under a conservatorship arrangement because of the 2008 financial crisis and bailout. This, between Freddie Mac and Fannie Mae, guys, they received the largest bailout, taxpayer bailout in all of U.S. history. And so that's part of the reason I want to talk to you about this new type of loan. Is this Home Possible Mortgage? Is this really just a subprime mortgage crisis starting all over again? Now, I'm not trying to be negative here. I don't make doom and gloom videos on this channel. That for the most part, I do not want to take this channel that direction. But really, I just want to take a step back and look at what's realistic here, what's actually going on. So Home Possible Mortgages, let's read a little bit about that. So we're on their website now. It says, effective July 29th, 2018, we are revising income limit requirements for Home Possible Mortgages to better focus on serving low and moderate income borrowers. Okay, so first thing I'm seeing there is they're revising the income requirement. They're lowering the bar for qualified buyers in order to get more buyers in. It says review single family seller/service guides in the PDF they have there, which you guys, all these links, everything we're going to be looking at on screen here today is going to be available in the description section below this YouTube video, so make sure you check it out, and you can find all the links to all the articles I show, etc. So if you want to go back and read this stuff in detail, you certainly can, guys, certainly can. Okay, it says all information reflected on this page will remain current and accurate until July 28th, 2018. So first of all, just from this notice, guys, what I'm seeing is they're reducing the income limit requirements for new-time home buyers, or people who are looking to obtain and acquire a mortgage. So right away, they're across the country, you guys, as long as you haven't been asleep, and so I think the people who watch my videos on this channel are not asleep and they're pretty aware of what's going on. But you guys have noticed the average home price across the U.S. has risen drastically. And so as homes become more unaffordable, as a lender, if you think of a lending institution, whether it's, Freddie Mac or, Fannie Mae or of any of these banks, well, how do they make money? Well, they make money by lending. And so they're loosening the lending requirements in order to sell more of these mortgages. And of course, Fannie Mae and Freddie Mac, they purchase secondary mortgages and then repackage them as and sell them as mortgage-backed securities. But going down the line here, because I don't want to go off point. So with this, under this new Home Possible mortgage, it's a 3 to 5% down solution. It says Home Possible mortgage offers a low down payments for low to moderate income home buyers or buyers in high cost underserved communities. I like how they use the word underserved. But there's a whole video about this right here, if you guys can watch it. And it just shows like a young couple getting a house, people of different ethnicities getting a house, for the first time. So it's a very, very inspiring video. But is it really helping the consumer? That's what I'm kind of concerned about. But as we go down here, it says which Home Possible mortgage is right for you. So there's two of them. There's the Home Possible, which is there's a 95% loan to value. And there's a Home Possible Advantage, which is a 97% loan to value. Now, I'm not going to read through every one of these, but if you wanted to see like what income ranges qualify, you can go right here, and you could click this link, and you can just like drop in like a street near where you live, and it will pull up what the income limit requirements are for you in order for you as a borrower to qualify for this loan. So if we click here, you could do that, but I'm not going to do that with you guys here. You guys can do that in your own time if you feel free to do so. Notice here it says flexible source down payments. Down payment can come from a variety of sources, including family, employer assistance programs, and secondary financing. So now, if you guys remember back in 2008 or around that time, the down payments were, I think it got to a point, now correct me if I'm wrong, but where you could virtually buy a house with no down payment, which is just absurd. But, or even like with a 2% down payment. Well, this is pretty similar to that, where now you can just come in with 3% down and purchase a house. And the mortgage payment, we're going to look at an example here in a minute. I don't think I could afford it. Like me personally, I would really struggle if I had that payment, but we're going to be looking at that. And notice down, the other thing I wanted to point out down here is, does bother me. It says no credit score necessary. Borrowers without credit scores are eligible for mortgages with down payments as low as 5%. So if you can come up with 5% of the value of the home, then you can get a mortgage. Okay, no credit score required. So let's continue here. So you guys can obviously come back to this website and check it out. But let's go to this next tab. Now, back in September, September 17th of 2008, according to thisisthebalance.com, it says the Fannie Mae and Freddie Mac bailout occurred on September 17th of 2008. The U.S. Treasury Department was authorized to purchase up to $100 billion in their preferred stock in mortgage-backed securities. As a result, they were put into a conservatorship by the Federal Housing Finance Agency. Keeping the two afloat, so keeping Freddie Mac and Fannie Mae going, cost the U.S. taxpayer $187 billion over time, making it the most massive bailout in U.S. history. And there's all these factors that led to the bailout, guys, right? There's like people who, there was one, in my opinion, if I look back on it, there was people who shouldn't be buying a home, were buying a home because they could, because the bank was just lending it to them without even, anybody who could fog up a mirror, the bank would lend them money. And to me, this is kind of heading back that direction, but why should they change when the taxpayer bails them out? And that's what really bothers me about this is, if these mortgages fell, is the government once again going to say, okay, well, we're just going to bail you out even more? I mean, where is the accountability? And I haven't seen it yet. And I would hope that we can live in a world where this does not repeat itself. But so far, it's looking like it's, to me, with home prices now across the nation rising, I'm not sure about that, guys. So let's move over to this. This is just from Wikipedia, but you can read about this. I'll leave links in it. But basically, it talks about the federal takeover of Fannie Mae and Freddie Mac and how it was placed into a conservatorship and just kind of how they've been running the operation ever since. So you guys can check this out on your own time because I don't have a ton of time to film this video today, guys. So I'll just keep going. Okay, guys, so we're going to be looking at an example of how the Home Possible mortgage would play out if we, looked at the real numbers. But I just want you guys to keep in mind that, America, I don't want to be negative here, guys, but realistically, people are more indebted in credit card debt than ever before. And you guys can read this article. Now, this was published at the end of 2017. You can read about the current balance. There's over $13 trillion in credit card debt. And this article was, at the end of last year, and I'm sure that's probably gone up since then. We have student loan debt surged by 6.25% towards the end of the last year, over 1.36 trillion. I think student loan debt is now at 1.5 trillion. I mean, it's just insane, guys. What's going on here is just really across our economy. It just blows my mind. People are so indebted in every aspect, and I just don't know how they're getting by. And I don't think many are, because I'm here in California where I live. I'm seeing homeless on the rise, like more than I've lived here for my entire life, and I've never seen so many homeless people in my entire life walking the streets as there are today. So 6.3 million Americans are 90 days late on their auto payments. So between student loans, credit cards, auto loans. Now, if you guys have probably seen some of my other videos about the average car payment, I have at least 2 videos on that on my channel. You guys, I'll link them up down below. But the average car payment, as you guys know, is around $500 to $503 a month, because the cost of a car has risen substantially as the value of our dollar declines. So we work harder for less money, and so that everything is costing more, including homes. So with these kind of things, like, I don't see how people can afford these homes. And I'm not trying to be negative here. I'm just trying to be realistic. If this is truly what's going on, I'm not saying these articles are 100% accurate, but if you read them and this data is somewhat true, then I don't know how people can afford it. Now, according to Zillow, the average median home price across the United States is now at $213,146. So obviously, it just depends on what part of the country you live in. I mean, each state has a completely unique real estate market. I know, like, California obviously is super expensive. As you guys know, it's probably the most expensive state in the country to live in. New York's very high. Anywhere near the coast, Florida, Washington, I mean, those places have pretty high home prices. Now, I know, like, in the highest real estate market, I believe, in the entire country right now is San Francisco. And the last I heard, it was at, I think, like, a 1-bedroom condo in San Francisco currently goes for like $1.2 million. It's just insane. So let's go on here, and we're just about to look at an example. So this is a article from the Value Walk, and it talks about how the housing is becoming more and more unaffordable. This was published in February of 2018, and basically says housing is not affordable, and explains why that is, which is why I think we're seeing new loans like this home possible mortgage loan, because these lenders, they want to keep making money by offering loans, but they're tweaking the rules again to sell more of them, to get more buyers in. When people, and it says right here, people are buying houses they can't afford, and I believe that's absolutely true. Now, let's look at an example real quick. I'm gonna go over with you guys, and like I said, all of these articles you can go back, check out at your own time, review them, and see what you guys think. I would love to hear what you guys think on this. I mean, are you guys seeing what I'm seeing? I mean, am I off the beaten path here? If I am, please correct me, but this is what I'm seeing, at least where I live, and I would love to hear what's going on with you guys around the state. I know I have a lot of viewers from Texas, a lot of viewers from New York, from Florida. I would love to hear what it's like where you live and what you're seeing in your neighborhoods and what's really out there from your perspective versus what we're hearing in the media. Okay, let's go over to an example. So I just did it on the Word doc, guys, because I didn't have a ton of time to produce this video this week, but okay. So we're going to look at an example right now of my house versus current home prices and this new loan. When by new loan, I mean, like, if we did the home possible mortgage. So my wife and I were very fortunate. We were able to purchase our house here. This is actually in California. Yeah, believe it or not, it's California. We live in the Central Valley of California, so we don't live anywhere near the ocean. This is more like farmland territory where we live. We live in a city, but anyways, it's more of the farming area of California versus the coastline. So that's why the house is so cheap. But so we purchased our house for roughly $185,000 in January of 2013. Our interest rate that we were able to get was 3.625%. We were able to put $45,500 down, and you're like, well, that's ridiculous. How did you do that? Well, we actually have a video on. If you check out my video that I made on how we got ahead financially, you'll learn how we were able to do that. I'll link it up for you guys in the description section down below. And so at that point, we had total mortgage debt borrowed of only $140,000. And just so you guys know, I mean, now I think we owe like $95,000 on our mortgage, and that's our only debt. We have no auto loan debt. We have no student loans, no credit card. I mean, I pay off my credit card every 2 weeks. So virtually we're completely debt free except for our mortgage. And so according to Zillow, I just looked at this just the other day. My house is now worth around $311,000. So our house has climbed significantly in value. And then now the median home price in the area in which my wife and I live is now around $326,000, depending on what house you're looking at. Okay, so our mortgage payment alone, and these are my real numbers, guys. Scout's honor. These are my real numbers. So my mortgage payment is $633. So my mortgage payment is $636 per month, and that's just the mortgage payment alone. So that's the interest and the principal. And then we have our taxes and insurance, which I consider to be part of a mortgage payment because you have to buy it. You have to pay your taxes and you have to pay your insurance. So tax on another $226 to our payment. So, and that represents about 1/3 of my total mortgage payment is my taxes and insurance. So our total monthly mortgage payment is $862 per month. So not bad at all. And so we don't struggle at all to pay that. We could lose our jobs today and we could still pay that. In fact, we could pay off our house if we needed to. So, but what if we bought a house today using the Home Possible mortgage loan? Okay, so we would have to look at the median home price in the area in which we live, and we would pay around $326,000 according to Zillow. If we put 3% down, a 3% down payment is just less than $10,000. Our mortgage debt borrowed would be $316,000 and so our mortgage debt borrowed would be $316,000. Our current interest rate, as you guys know, interest rates have been rising. So not only are home prices higher than ever, are almost higher than ever, but interest rates are climbing up. And I mean, still real low, 4.5%, still a low interest rate historically. But when you have home prices that are, $400,000, I don't think the average person can afford it. I know I would struggle to start making these payments. So mortgage payment alone in this example, and I did this little mortgage calculator on Google. It's just a great little tool you can run. There's the $1,602 a month, okay? But that doesn't include taxes and insurance. So if I use the same methodology of 1/3 of my monthly mortgage payment being taxes and insurance, well, as you guys know, as the insurance goes up, as the cost of the home goes up, so does your insurance costs and also your property taxes. And so if I figure that into the equation with my total monthly mortgage payment in this new example under the Home Possible mortgage would be $2,163.70. Now, that's a rough estimate. So does that sound reasonable to you guys? That's with taxes and insurance built in there. So it might be a little bit more, it might be a little bit less than that, but I think I'm right around probably what it's going to be in terms of a mortgage payment. Now, I don't know about you guys, but if I had to make this payment, my wife and I would not be able to save very much money at all. We would be pretty far behind. And so if you look at what we're paying, which is $862 a month, and so if we take this total payment of $2,162.70 divided by our current payment, that would mean we're paying 2.5 times more than what we are right now for a mortgage. And that's just living. That's not utilities. That's not, that's not all these other things that we have to have in life, like food, other kinds of bills and things like that. So, I guess what I'm saying, guys, is realistically, like I said, I'm not trying to be negative, but realistically, could a person afford this payment? And I don't think so. I don't think a person could afford it. Let me know if you guys disagree, but I think the only way, or one of the ways a person could afford this, is if they had multiple people living with them and they were renting out the bedrooms, and that might work in that instance where you have other family members who are paying rent. But I can tell you guys, like, if my wife and I were in this situation and we lost our jobs, one of us lost our jobs, we would not be able to make it on this payment. We would have to sell the house or do something drastic to fix it. Versus up here, one of us could lose our jobs and we're fine. We can totally handle it. But down here, the house is going to have to go because we cannot make the payment, or we're going to have to rent out the house to bring in other sources of income to try to keep it. So that's kind of what I'm seeing. This is kind of how I'm looking at this mortgage, guys. So bottom line is, I think in the next couple years, we're really going to see a downward turn in the real estate market. Now, it will be slow going. I don't know if it will be as big as 2008, but I don't think they'll loosen the loan requirements as much as 2008. But as you can see, they are starting to loosen them more and more and more to try to sell more and more mortgages, just because that's how they make their money, and they don't want to stop selling them. But they know that people across the country are running out of options and cannot afford homes. And that's why, because of supply issues and other issues, obviously a huge one is supply, because a lot of it's real estate investors have bought up a huge portion of the real estate across the country. Like Blackstone has I think over 10,000 single family homes or something like that. The last time I read, there's all these other, and I get letters all the time. Like once a month I get a letter for somebody offering to buy my home. Well, there's no way I'm going to sell it, because the person I'm going to sell my home to is just going to turn around and put it up for rent. So why would I sell it when I have this asset that is appreciated in value and I can rent it? Now, just so you guys know, let's say I wanted to rent my home out, right now I could rent it out for about $1,600 a month, like anywhere from $1,400 to $1,600 a month. So we could easily, turn a profit on the rent. But you know what? And if you look at Zillow, or where did I find that information? Well, so in one of these articles, I found that the median rent price in the country is around, right here. It was on this Zillow article. The median rent price in the United States is $1,600 a month. So my house would rent for about that. But anyways, guys, that's why I wanted to cover this Home Possible Mortgage series, this Home Possible Mortgage, because it's something that kind of disturbs me that they're doing this again. And it's like, if this fails again, will the government take money out of our taxes and bail them out once again? It's like, can they lose? Can they lose? And I don't know. I don't know if they can lose, because they can just loan money out irresponsibly if the government's just gonna just take the money right out of our pockets of the working class citizens who pay taxes, and that really disturbs me. But okay, last but not least, guys, I found. If this is coming from the census.gov, and then we'll wrap up the video right here after this. So this is census.gov construction. So this is median and average sales prices of new homes sold in the United States. I'll put a link to this in the description section of the video. So it covers all the new construction of homes back to 1963 to now. And it's 11 pages, but let's just look in the 70s, okay? If we look in the 70s, it goes by month. In the 1970s, the median average price of a new home was between 20 and, if we keep scrolling, about 40,000, or I guess towards it got up to about 60,000 by the end of the 1970s. Okay, now if you look at that, obviously it was in like the $45,000 range for a good period of time. So let's just, as an example of January of 1977, let's compare that, the $45,000 median price, to today. So if we scroll all the way down, it's going kind of fast. Come with me now, come with me. And at first I didn't think they had these numbers in here, but I just kept scrolling, then I saw them. So now here we are in March of 2018, and the median average price of a new home construction price is around 300. This is the median column. This is the average column. So it's between $337,000 and $369,000 as of today. So homes, compared to when your parents were able to get them, are now, based on these numbers, let's just say the new home price is like $350,000, okay, compared to around $45,000 in the mid 70s or so. So homes are about 8 times more expensive than when your parents were purchasing them. And that's why I think we see a great shift in families struggling across the country, as our dollar cannot keep up. Wages can't keep up with this. So what I think is going to happen in the years ahead is there's going to be a major correction. And so if you're looking to purchase a home, I don't know if I would do it right now. I'm not a real estate expert, but it would be hard for me to justify paying the prices as high as they are right now, especially when I can see these mortgage lenders starting to loosen their standards, and I think you're going to have better opportunities in the future. So my wife and I have been saving on the side for years, and so we're ready for a crash. Actually, we would like to get another home, a better home than what we have now. But we do not want to pay these outrageous prices if we don't have to. So we'll see what happens, guys. But let me know what you think. Am I off base here, or do you guys think this will work? Why or why not? Let me know. I would love to hear your thoughts on this, guys, and I would really love to hear what's going on around your neighborhood and wherever you live in the country. And share. I would love, just let me know what you're seeing and what's going on out there. All right, guys. Love you so much. Thank you so much for taking time out of your day to watch this video. If you have not already subscribed, be sure to do so, because usually every single week I make new videos that cover finances, investing, and taxes. And I try to make a new video once a week. And if you'd like to see more content like this, let me know. Please share this information with a friend, especially a friend who might be considering this home possible mortgage option. You might save them a lot of heartache. Excuse me. Now, one last thing I wanted to mention is that, back in 2008 when the homes foreclosed, people could walk away from the cancellation of debt that they had on their mortgage. Well, as the current tax laws state, that's not going to work anymore. So if a person loses their home and is, they're relieved of their debt obligation, well, they can no longer walk away from that tax burden, because they're going to have to report that cancellation of debt as income on their tax return, and they're going to end up owing the IRS. So I don't know. I just don't like what's going on here, guys. But let me know your thoughts. All right, guys, I got to head out, but I love you. Have a great week. I'll talk to you later. Bye.